In the last video, we quickly introduced the concept of internal control and talked about how cash is one of the assets that is the most at risk for a business. Doing regular bank reconciliations is an important part of the control process for a business and is often taught in introductory accounting. So it's definitely important to understand how to do a bank reconciliation, but first we need to understand why we are doing one. And that's what this video is about. Let's take a look. Businesses use their bank account as a control device. The most obvious control is the safeguarding of cash. But from the business's perspective, there are controls of value beyond that. Consider the independent records kept by the bank, which the business has access to in the form of bank statements. That's a record of the same transactions that the business is keeping track of, cash receipts and cash disbursements. These two independent records of the same transactions are a great way to ensure accurate and reliable reporting of cash. But it might come as a surprise to you to learn that these records often do not equal. Well, the reason is due to timing or timing differences. Let's look at an example. Consider a customer, or we'll just call them a buyer, and their supplier, which we'll refer to as a seller. The buyer puts in an order for inventory or goods of some kind, and the seller ships them. Maybe they ordered some hats. Upon receipt, the buyer issues payment, maybe in the form of a check. This is the kind of example we've been looking at up until this point, but it's a bit more involved than this. Let's take a look at things from the buyer's perspective. The buyer has their own accounting system, and they will record the receipt of those goods. And that'll be done with a journal entry as follows: a debit to inventory and a credit to accounts payable. This is a perpetual system of inventory. Eventually, when it comes time to pay the supplier, they'll do that as well. That'll be done with the following journal entry: debit accounts payable and credit cash. But doing that isn't enough to actually get cash from the buyer to the seller. Another step is required. In this example, we are saying that they will remit cash by issuing a physical check. So that check has to go on its own journey to get to the seller. Maybe it starts off at a post office or a mailbox, then it has to get into an airplane, and eventually it's received and opened. But even then, we're still not done. There are things that need to occur on the seller's end. The seller has their own accounting system, and they'll record the receipt of this cash in that system. So they will debit cash and credit accounts receivable. But there's still more to happen to that check. It has to physically go from the seller's premise to the bank. And so you can see, while all that is happening, different parties are recording the transactions at different times. Timing differences. It's even more useful to look at it from the point of view of a calendar, specifically the very end of a month. That is typically when a bank issues something called a bank statement or their record. So the bank will show the parties what they have in their bank account according to them at the end of the month. But things might look different from the perspective of the buyer or the seller. Let's take a look. So the buyer, from their point of view, has already recorded this transaction. They've recorded the receipt of goods and then the subsequent payment for those goods. And we know that they put the check in the mail and that check went on its own journey. But until that check clears the system, it'll be called an outstanding check, which basically refers to a payment via check recorded by the company and not by the bank, at least not yet. And let's look at things from the seller's point of view. The seller will also have recorded this receipt or this check, but it hasn't cleared the bank yet. So from the seller's point of view, checks like this are referred to as deposits in transit. and that means any deposits recorded by the company and not by the bank. So now you can see a little more clearly why these two records will not equal. But we know what the differences should be, and we can reconcile those, and in fact we do, using something called a bank reconciliation. In other words, we can look at the bank balance, and to that we can add deposits in transit, subtract outstanding checks, and adjust for any errors. Similarly, we could look at our own records, and we could add any EFT deposits, credit memos, subtract any non-sufficient fund checks and service charges, and adjust for any errors we find on our own side. These two balances would basically be the adjusted cash balance, and they should equal. In the next video, we'll take a look at how to actually do a bank reconciliation. So see you then. Thanks for watching.